Coming up today, the stock market has its worst week in over a year, on more weakness in the jobs market. Is now the time to buy the dip, or is it time to run for the hills? PLTR and DELL to be added to the S&P 500, a look at government spending, and the latest ideas from billionaire Ray Dalio. It's a big day, guys. Let's go. Hey, I'm Jared. Welcome to Click Capital. Other people want to make friends, I just want to make you money, because my job is not just to entertain you, but to educate and teach you. So don't call me on 1-800-CLICK-CAPITAL or tweet me at Click Capital. Alright guys, just a little bit of humor to start off. What was quite a sour way to finish this week out. But just before I dive into the daily market review and get you all updated, if you're new here, welcome. I make these videos every day after US market close, breaking down all the most important news, data, and events for you. So if you haven't already, hit that subscribe button. And these videos will show up in your feed each day. And thanks to everybody who continues to hit that like button, helping these videos to stay in your feed as well. And just a quick reminder how you can get the best viewing experience out of these videos. So each day I cover a broad range of subjects, giving you a curation of what I think is the best news, data, and charts across all financial markets, stocks, bonds, commodities, cryptos, currencies, also covering economics and geopolitics. However, if you're not interested in a particular subject, I split up each video into about a dozen different chapters. And so you can just easily skip ahead, whether you're on phone, desktop, or on your TV. You can just skip ahead to another chapter. And I do speak quite fast, so if you'd like to slow it down in your video player, just go to settings, click on playback speed, and I recommend going up to custom and taking it down to 0.95 or 0.9, just to slow my voice down by 5 or 10%. Some people may find that a lot better. Okay, without any further ado, let's dive right into the daily market review as usual. Turns out option dealers were right yesterday, as I let you guys know. Saw that spike in the VIX one-day index late yesterday afternoon, letting us know we could be in for a bit of a spicy session going into the weekend, and that's exactly what we got on the back of the jobs report, which I'll dive into in a bit. And so it's not unusual to see the market get a little nervous going into the weekend, take a bit of risk off the table, and it was kind of looking like whatever number we got today from the jobs report, the market was going to sell off anyway. As I've been noting, it's been on quite soft footing this whole week. In fact, the worst week we've had in over a year. We can see that in market color as well. Red all over the place, especially up the front. Anything green across the board, volatility, the VIX index, and funny enough, high yield bond. However, everything else pretty much took it on the nose today. Bit of a bearish breadth of a day, and you can see that looking at the heat map today. We haven't had a full bear day like this in quite some time. Every sector finishing lower, although there was some spots of green in the healthcare sector. A little bit of a defensive move again there today on a theme we've been really seeing this last month or two. A move in the defensive sectors like healthcare, utilities, consumer defensive, and REITs, also trading a little mixed underneath the hood there today. However, what was different between yesterday was mega cap tech was the winner yesterday. They took it right on the nose today, getting hit pretty hard there, especially in the semiconductors. Broadcom down over 10% after their earnings, and the big fella Nvidia getting chopped another 4% as well. Like I'd been noting of late, quite a bit of selling going in semis. Not really good for this bull market considering they've been the leader of it. And there's a look at the daily chart of the semiconductor ETF, which has been consolidating all the way since back in early March. Pretty much gone nowhere for half a year now. And so they're definitely being tested here. Just looking at Nvidia, coming down to its prior earnings gap we got back in May. Its most recent numbers were pretty good, $50 billion buyback. However, the market's reaction was bad. Then we got news the Department of Justice is sniffing around, potentially lining up an antitrust lawsuit, as they do pretty much have a monopoly on advanced GPUs. And there's a look through all the semis today, getting hit hard, and other big stocks as well. Just after Tesla was looking good yesterday, popping above its 50-day, did a big bearish engulfing candle today, finishing right on its lows, down a whopping 8%, just as the Nasdaq did as well, finishing down about 2.7%. Pretty big down day, and really not a good week for this shortened trading week. And could get even more spicy next week. We got CPI inflation data coming out on Wednesday. That'll be the big one for next week. We also got Apple revealing their iPhone 16. We'll see if that can put some support in the tech stocks here. However, it's also small caps as well, getting hit hard, pretty much been consolidating for a few months now. And stick with me because I'll come back to the charts later and I'll show you what else is going on out there with breadth and volatility, along with some spreads. We'll also touch on Bitcoin as well, and of course commodities. And I've got some interesting stuff for you in regards to government spending. And I'll also share with you Ray Dalio, who's the founder of the world's largest hedge fund, what his thoughts on a wide range of topics and markets are later on in this video as well. And just as I said at the start, if a particular topic doesn't interest you, for example, if you don't want to hear me talk about economics or geopolitics or criticize criticize government spending, then you're free to jump to the next chapter, to the next topic of interest. First, let me just put the shape of this market into context for you. And so without a doubt, it is soft here for sure. It's on loose ground. Seasonality appears to be playing out right on cue. As expected, September is the worst month for the stock market looking back in history. Could be a case that we're all just too well aware of that now. We may actually be front-loading a bit of that seasonality, given markets are off about 5% already this first shortened trading week, the worst sell-off since March 2023. And this is on the back of a defensive rotation that has been taking place for a month or so now. Just looking back in history at the 4 defensive sectors, staples, utilities, healthcare, and REITs, when those 4 sectors are all outperforming the rest of the market for the first time after being reset, as we can see here in the red dots. And I'll just zoom in a bit so we can see better what the prior price action we've got after that. You can see there in 2011, went on to consolidate and contract. Again in 2012, consolidated. 2013 was an easy year in the stock market, just pretty much a parabolic grind up. Bit of volatility in late 2015, going into 2016 as well, and in late 2018. I'm sure a few of you remember that sharp sell-off we had. Going into the end of the year, bit of a defensive rotation prior to that. Of course, at the start of the sell-off in COVID, and then just after the market peaked in late 21, where defensives held up better. However, it was actually energy that was the leading sector in 2022. If you followed market breadth, that was really clear. But here we are now getting the signal again, defensive rotation. We very well could be in for a period of at least consolidation here, if not a full-on correction or pullback. And once again, people drawing comparisons between the current price action in the Nasdaq to that of the S&P 500 back in 1929, which the market experienced one of its biggest crashes ever, and that also happened just to come out of September. Going into October and November as well. However, whilst anything is possible in markets, I'd say this is highly unlikely, given markets have changed a lot since then. They're much more supported by continual buying of pension funds, corporate buybacks, not to mention modern day exchanges have circuit breakers now, where stocks and the market entirely can get halted, causing a pause, allowing the market to catch its breath. However, it doesn't mean we can't do that price action over the course of several weeks or longer, like we saw in March 2020. It was a really sharp sell-off. It was just done in a real orderly fashion. Some of you may remember there was talk of shutting down the stock exchange, which I think they were actually deciding on, but they kept it open, and it was quite the wild time in markets. And so it hasn't helped the picture when the so-called godfather of AI, Jensen Huang, born in Taiwan, now the CEO of the world's second largest company, just been offloading a lot of shares for the last couple of months now. Over 5 million shares, now approaching $750 million. However, that's not stopping Bank of America saying this is setting up a really good buy the dip opportunity, saying the stock's trading near its lowest valuation in 5 years. They think it has a potential 54% upside with a price target of $165 a share, pretty much pushing aside any potential pursuit from the Department of Justice, saying that doesn't affect the whole bull thesis and story for AI, and Nvidia is still well and truly the leader. And it'll be interesting to see what the market's reaction is to Apple's iPhone event, which is due to begin this coming Monday, 1 p.m. Eastern Standard Time. Dubbed its Glow Time, they'll be streaming the event. You can watch it on YouTube. They're expected to announce new iPhone colors, updated cameras, new AirPods, Apple Watch. Investors will be looking for their generative AI plans, potential AI integrations. Got the street warming up to the stock. Bank of America rates it as a buy with a $256 target. And of course, the big one is details on their coming new smartphone, the iPhone 16. And it has kind of been holding up a lot better than its peers. Not only today, only down 0.7%, but over the last couple of months as well. Market's really been keen off this new iPhone, expected to come out soon, and the market's pretty much pricing in. That's going to take Apple back to some growth, get a whole new iPhone upgrade cycle happening, and that's why it's sitting pretty. Market cap of $3.3 trillion. And so we'll be paying attention to Apple come Monday night and what the market's reaction is on that day and for the rest of the week as well. That'll be a key one to watch next week. And good news for Palantir shareholders like myself, something we've been waiting for a while. Just happened after market close today. Nice little surprise after all our portfolios took a bit of a haircut in the regular session. With S&P Dow Jones indices confirming that Palantir and DELL will be added to the S&P 500 index following today's close, with Palantir replacing American Airlines and DELL replacing Etsy. And the post-market session just closed. Got a nice pop on the back of that news. Palantir up almost 8% after hours. And there's a look at the daily on Palantir. Still holding above its 50-day and doing a bit better than the rest of the market. That gap down on the 5th of August was a temporary and fleeting gift. And there's a look at DELL as well, slapping on about 6% after hours. However, its stock has been quite weak last couple of months, coming off quite a bit actually. So this may put a floor in it because there's hundreds of billions of dollars that are linked to the S&P 500 indices all around the world. So many products, ETFs, mutual funds, hedge funds, etc. They're mandated to own all of the stocks in the S&P 500. And so any stock in the S&P just kind of helps it get some permanent and large institutional capital. Also, something interesting I thought I'd share with you guys today. Stock I recently mentioned has potentially been cheap for a growth stock, and that's athleisure maker Lululemon, one of the worst performing S&P 500 stocks this year, falling over 50%. We just got news. Kelvin McDonald, their CEO for 6 years, just made his first open market purchase of 4,000 shares at $260 each, totaling over $1 million. Pretty good signal of his confidence of him being able to turn around the company and stock. And $1 million is significant and a pretty good sign to the market, which, like I said, the stock has been struggling pretty much all year. Ever since it peaked out late last year above $500, been cut in half. Here we are at $253. Recent earnings just beat a little bit, reporting a really good $3.15 in earnings per share. And like I've been saying, it's pretty rare for a high quality brand and fast growing stock like Lululemon to trade below what my fair value indicator has it at. It should be trading at a premium, as its sales are still growing. And even though the technical trend here, just looking on the weekly chart in my trend candles indicator, is most definitely down. Not saying we've definitely hit a bottom. Bottoms are a long, messy process. After we go from that stage 4 decline to a stage 1 accumulation, it can bounce up and down, retest, fake out, retest, double bottom, bullish divergence. All of that stuff can take a little while to play out. However, for the patient investor, Lululemon shares are definitely on sale at the moment. Similar story in beverage maker Celsius. Really popular growing drink. Expanding around the world, sales are still growing. It too, trading below its fair value, but still clearly looks to be in a downtrend here. Could very well go into the 20s over the following weeks and months. And so not only do we have signs of softness in the economy and the stock market, along with stretched valuation, could be the same deal and residential real estate. And this is not just in America, this is across the West. Residential real estate valuation, the highest they've ever been compared to the average household income, compared to rents, compared to their long-term trend, compared to just about every measure out there. And now we're seeing signs of softness. The number of homes for sale that saw a price cut in August rose to 19.3%. That's the highest rate of homes that saw a price cut in the last 5 years. And like I said, similar story in real estate markets around the West. Increasing supply, signs of prices coming down, price cuts, and so it could be turning into a buyer's market. However, it's taken us a long time to get there. It could be a process of normalization that takes years as well. But just moving on to the biggest news story today, that was the jobs report, which we get on the first Friday of every month. A look at how many new jobs have been added in the US economy for the prior month, along with the unemployment rate, which came in as expected, 4.2%. However, the amount of new jobs created came in below expectations, 142,000 versus 160 expected, and that's been trending down pretty much for over a year now, on just another sign of softening in the jobs market. So financial markets a few months ago were all worried about inflation coming back, whether the Fed could start cutting or not. However, we've had some convenient falls in the price of oil, and what markets have switched their focus to over this last month or two is the jobs market. Us investors are worrying about the softening US jobs market because we're currently in a bit of a soft landing at the moment, and that could continue. However, the risks of going into a recession are rising, and that's because the amount of new jobs being created is in a downtrend and the unemployment rate is curling upwards, which we typically see before a recession. What pushes the economy over the edge into a recession is really a spike in the unemployment rate. A lot of people losing their jobs, which makes them obviously pull back on discretionary spending. That causes the economy to contract. Less goods and services being purchased, less business spending and investment as well. And the fact is, just like we saw today in the report, most of the job losses are coming from native-born Americans. Immigrants into the country, both legal and illegal, is where all the new job growth is coming from. In fact, ever since the start of 2021, the amount of foreign-born workers in the country's exploded, whilst the amount of native-born workers, whilst it recovered somewhat to pre-COVID levels, the amount of native-born workers in America is actually below what it was in late 2019. With some saying the Great Replacement theory may just be real looking at this data. And it's not just the states where the jobs market is weakening, we're also seeing that in Canada as well. Their unemployment rate ticking up 6.6%. However, since the unemployment rate in the states is remaining at 4.2%, there was fears out there it may spike above last month's report, which was 4.3. And which if it came in at 4.4 today, I would start favoring the odds of a 50 basis point cut. However, that doesn't look likely at this point of time, given that the unemployment rate actually ticked down from last month. And so that's kind of pulled back the market's expectation that we will get a 50 basis point cut. But it was a wild ride for Fed Fund futures today. They were all over the shop, spiking up and down, the number of rate cuts priced in for this month. In fact, we saw the highest record amount of volume traded in Fed Fund futures today, and they're back to pricing 70% chance of a 25 basis point cut and 30% chance of 50 basis point cut. And that's where I'm going to put my odds at exactly as well. After today, I'm going to give more odds back to a 25 basis point cut. Given unemployment came in at 4.2, even though jobs growth was a bit weaker. I think at this stage, and of course, especially at this point in time, it's a really fluid and dynamic situation. If we see inflation come in really soft next week below expectations, we'd have to increase our odds again of a 50 basis point cut. And if we see anything in credit markets start freezing, are actually holding up pretty good, that could edge the Fed on to do a 50 basis point cut. However, at this stage, I'd still give a bit more odds. They'll just start off with 25 basis points. When they decide on that, in a little under 2 weeks from now on the 18th. But if they do trim rates by 0.5%, it's not clear cut how the markets will react. In late 2007, when they did the same, stock market did rally up just before it made a top. Kind of eerily similar setup to back then actually. And so markets don't always repeat exactly like they do in the past, and that's because markets learn. We all become aware of this data and historical patterns, and so the market could very well sell off if the Fed does chop rates by 50 basis points. But one thing's for sure, they're definitely going to start cutting. We heard that today from New York Fed President John Williams. Didn't really indicate they were going to start off big, but said they're definitely going to get moving. And there was even more of a dovish tone coming out of Chicago Fed President Austin Goolsbee, warning about the risks of a job market slowdown, pretty much saying if you want a soft landing, you can't be behind the curve. You got to get out in front of that thing. And so he appears to be arguing for a bigger cut to start with. Just like we heard from a Nobel Prize winning economist, Joseph Stiglitz, says the Fed should deliver a big rate cut no matter what the jobs data was going to be today. With an interesting point saying, if you think about it, how do we deal with the problem of a housing shortage, which is increasing the price of inflation? Do you think raising interest rates, making it more difficult for real estate developers to build more houses, homeowners to build more houses, is going to solve the housing shortage? No, it's going exactly the wrong way. And there's a few other economists out there calling for 0.5% rate cut as well. JP Morgan, and pretty much arguing that the Fed needs to be more proactive instead of reactive. Truth is, there's got to be a bit of a balance of both. But as investors, it's just impossible to ignore this chart, the spread between the US 10-year yield and the 2-year yield, which well and truly went back to uninverted territory today. Market now in a bull steepener. That's typically what happens 6-12 months before a recession, after we've had one of the longest inversions on record. And it's pretty much got a near perfect track record. In fact, they've preceded every recession since 1976, just like we can see in this chart here. The light shaded grey being recession, the red line spread between the 10-year and the 2-year. Pretty hard to argue that it's going to be different this time. And so looking back at recessions, stock market typically doesn't make a bottom until it's in the recession or afterwards, and cyclical tech and growth stocks can get hit really hard, especially if they're coming off lofty peaks. Looking back to 2008 recession, when the S&P went down 55%. Stocks that held up were like defensive stuff. Walmart, dollar discount stores, some healthcare stocks, a few utilities, kind of stuff like that. Defensive stuff holds up the best in a recession. And typically long-dated bonds as well, like TLT, that can hold up, along with gold stock. However, according to some, that's not a reason to panic. Still the potential of a continued soft landing, they say, and we could get gradual rate cuts instead of sharp ones. And there is a big difference between the two. In fact, just looking at the S&P 500's performance, 6 months before and 12 months after the first rate cut here in the red line, with fast cycles being in the red and slow cycles being in the blue. Fast meaning the Fed's really cutting rates quickly, like they did in the early 2000 and 2007. They were doing 50 basis point cuts. They actually even did a 75 basis point cut back then as well. That's the Fed scrambling to respond to a sharply weakening economy. That's typically not good for the S&P 500 the year afterwards. However, if they gradually cut rates, we get that soft landing and the stock market can actually hold up. And we saw that back in the mid-90s and the mid-80s, a few other times as well. However, regardless of what all these analysts and research says, you really want to pay attention to the price action in key markets. And just looking at treasury bond yields, they are signaling some economic weakness, especially this week, sharply pulling back. And of course, mostly up the front, giving us that bond yield inversion. Look at the 2-year. Really swift downtrend here. Finding new lows again today. Actually even taking out the 5th of August lows. Now trading at 365. A huge gap between where that and the Fed funds rate is. 525 to 550. So the market and the Fed are in two different spots right now. Fed's way up here. It's got a lot of catching up to do the market. And they typically converge after they have these big divergences. And which they haven't had a divergence like this in quite a while. Just looking at a long-term 3-monthly chart of the 2-year yield in the candles, and I've just overlaid it with the Fed funds rate here in the blue line. Look at that big gap, just going back in history. That may just be one of the biggest divergences we've ever seen, in fact. And so basically the bond market is saying, hey Fed, you really need to cut your rates. Things are not looking so good here. What are you doing up here? And typically the bond market is right. And that's why we can't rule out a 50 basis point cut, because the 2-year yield is actually implying more than that. But just because we got the bond yield inversion, things are not looking so great, doesn't mean stock market's going to get created straight away. It can take a little while. That's why we've still got some like Ned Davis research saying buy the September dip in stocks as the market heads into the best 3-month stretch of the year. It's going into Christmas. Typically get that Santa Claus rally. Volatility quietens down, and so seasonality could very well play out. And we may just make a bottom sometime this month, if not next month, as the things that really drive the market, like corporate earnings, are still trending up. And we've still got the top 20-30% of consumers spending pretty good as well. It's just the bottom 2/3. They're pretty much already in a recession. Another sign things aren't so great in the global economy is looking at the price for the most important commodity in the economy, and that is crude oil, dropping sharply this week, 8% on the prospects of a slowdown in demand in the world's 2 biggest economies, the States and China, along with plenty of supply out there and the market just ignoring what's going on in the Middle East. And like I said, really good timing for both the Federal Reserve and the federal government, having crude sharply dive right at the time when they need to cut rates and going into the election as well, bringing down the price of gas. And we just took out the bottom end of this support range a little bit here today, getting down to a 67 handle briefly before settling around $68. Holding up a bit better today is gold, which did sell off like pretty much everything, but still trading near highs, 2,500 an ounce. Bit weaker is silver. That too's been consolidating for a few months. And Bitcoin, just like semiconductors, to which they correlate with a bit, getting down to technical support below $54,000 a coin. That was the 5th of August there. We put in a big hammer candle formation, and that is a key level where the market's turned a number of times before. Big psychological, $50,000 a coin. It too conveniently trading pretty weak going into the federal election, as one side's really in favor for it, the other side's kind of caught in the middle. And speaking of the government, just looking at their spending a little bit. And I know this is a bit of a sensitive subject, so if this is not your thing, that's fine. Feel free to skip ahead to the next chapter. However, what's got a lot of Americans upset is that over $100 billion of their taxpayer money has been sent to help Ukraine defend its border. In fact, it's over $175 billion. And why that upsets a lot of Americans is because this current government hasn't even spent half of that defending their own southern border, which has been largely overrun this last 3.5 years. With some people questioning, why has this government sent so much money to Ukraine, especially as the son of the president just pleaded guilty to federal tax charges on money he's taken from countries and companies all around the world over the last decade. In fact, their family's taken in over $27 million personally from foreign entities since 2014. They both traveled to China, Ukraine. We just don't know exactly what it was they were selling. And it's interesting, this current race. We're getting a lot of what you would consider outsiders kind of joining in. Being led by Elon Musk, with him potentially heading up a new government spending efficiency oversight commission to make sure taxpayers' money is being properly spent and accounted for. Now we've got billionaire hedge fund manager Bill Ackman coming out today and saying so much for free speech, as the potential next president has just said she'll direct the Department of Justice to censor misinformation and hate online. And who knows, maybe Click Capital will be classified as spreading misinformation, as I certainly don't toe the line. And even though it's clear the government has been overspending, clearly contributed to record inflation, a lot of people struggling, the geopolitical situation looks the worst it ever has in our entire lifetimes. However, there's still people out there that are arguing we must fight the system by making it bigger. The goal is less government, not more government. But don't worry about the jobs market for the government. They're doing just fine. The previous administration added about 500,000 new jobs to the government. Current administration added 3 times that number, 1.5 million new government jobs. It's kind of hard to believe. In America, there's 23.3 million government employees. Just think about that for a second. There's about 160 million US adults in the workforce. You've got about 18% of them, almost 1/5, working in the government. And so just to use my analogy of a sports game yesterday and the government being the referee or umpire, think about America's most popular sport, the NFL, where each team's allowed a maximum of 69 total players, plus they have more than that in coaches and other staff. Total size of just players and coaching staff and the like, not including all the other admin and organization around the team, it's typically between around 150 to 200 people that can be out there on the field on each side. So let's just use conservative estimates of 150. 2 teams, that's 300 people. And in an NFL game, they have 7 umpires on the field. So in other words, the ratio of umpires to the size of the 2 teams out there is a little over 2%. However, in the economy, the amount of umpires, the government, almost 10 times that amount, 20%. The government's simply too big. And when you have a big government, they naturally do a lot of spending. And if the US continues on this trajectory, they're on course to double their debt in just 8 years, with a sharp increase starting in late 2020. In fact, the US has added 11 trillion in debt since 2020, just the last 4 years. Prior to that, it took 220 years just to reach 11 trillion. It's just simply not sustainable. However, some people seem intent on turning America into the next Venezuela or some other banana republic country overrun by its government. And that's why the US dollar may face more downside risk ahead. You can't have a country just blow out its budget, spend like crazy, continually wage wars around the world, have an open border policy, and expect the value of the currency to hold good over time. It just simply is not the case. And so it doesn't matter whether you're politically from the left or the right, it should concern everybody. And that's the case with Ray Dalio as well, who actually comes from the political left. However, he said he's disappointed, and both candidates, and him, along with many others in finance, are really worried about the US's state of finances and what the potential future holds. So the growing debt as a big key risk, along with bond yields, the conflict over wealth and values, the clash of the political right and left, international power conflicts, most importantly between China and the US, acts of nature, and technology AI. Ray said, when I look at those five, the first four are concerning, and the fifth is a two-edged sword, referring to AI. Says stocks look a little bit high, and there are big risks, saying those risks are political, saying a change in tax rates, unrealized capital gains, that would be negative for the stock market, and just points to the polarization in America as being a key risk as well. Whilst at the same time, there's a strong pursuit from other countries to get off the US dollar and rise, China and Russia leading the charge. And there's a look at your economic calendar today. Eurozone GDP growth, Q2, a little bit worse than expected, 0.2%. Real anemic growth year over year, 0.6% as expected. Canada's unemployment rate coming in a touch hotter. And there's the non-farm payrolls, weaker than expected, but unemployment rate as expected. Looking out to next week, don't have a whole lot to start the week off. Wednesday will be the big one. Inflation rate, headline month over month, expected to be 0.2%, year over year 2.6%, with core at 3.2. We'll be really paying attention to these numbers next week, along with the market's reaction. Then on Thursday, PPIs, jobless claims, into Friday, we just get some import and export prices, along with the Michigan Consumer Sentiment Survey. And just getting back into the charts, volume breadth, most definitely weak to finish this week out. Bit of a dive in the percentage of stocks above 50-day average, still holding above half though, and a bit of a climb in the amount of stocks making new 52-week lows, and a real flat volatility term structure. Looking at this, the VIX 9-day, the VIX 30-day, the 3-month and the 6-month, all on a 22 handle, close to going into backwardation. So the market's a little bit on edge here, and what gave that away to start the week off was volatility risk premium, getting back into positive territory. Option dealers demanding 6% of premium above realized volatility to sell option contracts, potentially forecasting some more volatility around the corner. And like I said, we really don't have the best price action going on in bond yields here. And that's typically really supportive for bonds. That's why we saw TLT make new highs today. However, not joining in on the party, potentially signaling a turn. High yield bonds, bit of a spinning doji on volume there, pulling back today, even though yields sharply fell, indicating a little bit of risk coming out of this market. Not to mention, we're seeing the yen coming back on some currency pairs out there. Bit of a dive there on the Aussie yen today. And in fact, dollar yen is now trading at those lows from the 5th of August. Like I said, that could be another risk for the markets. Another unwinding in the yen carry trade. Commodity market as a whole making new lows today on the back of crude falling. What also gave it away of late, growth versus defensive sector spread. Couldn't reclaim its 50-day. Could potentially be a little oversold here in the short term. However, that may not be a good medium-term signal, with high beta stocks having come off versus low volatility as well. And pretty much every stock sector, even the defensive stuff, finishing down today. Growth momentum taking it on the chin, and Tesla and Nvidia along with semis all really weak here. So market's definitely been tested. September weakness definitely playing out. We'll see what the market does in its reaction to inflation data on Wednesday, along with the Apple news event. See whether that can hold up tech a little bit. Otherwise, we're pretty much finished Q2 earnings season. The market's left to trade on its own devices, and like I said, we could be in for a bit of a roller coaster ride over the next month or so. Thanks very much for sticking with Click Capital. I appreciate all your support. I hope you have a great weekend, and I'll see you again on Monday night. Cheers.